Hi, we are back finishing up cash from chapter 7. This video is for class 23 for Monday, Wednesday, Friday students. And if you are in Tuesday, Thursday classes, this is the last video for class 16. So there's really 3. So this is the 3rd video for class 16. And we're continuing on talking about cash, and we're going to talk specifically about using a bank account to control your cash at a company. It's pretty much the same as using a bank account personally. So if you have a checking account, it works the same way, but just companies are a lot more likely to write checks. All right, so keep that in mind. They're probably not using the debit card. They're not checking the ATM to see what their balance is and then just taking whatever's in there. They're keeping up with the balance all day, every day. So every time a check gets written, it gets accounted for. And every time a check comes in, it gets accounted for. So we're going to learn how businesses keep up with their checking account, which you could apply these to your checking account. You could always keep up with your checking account if you wanted to. That is something that can actually happen, and it works the same for a personal checking account. Cash is the most liquid asset reported on the balance sheet because it is the medium of exchange, meaning that's how we trade with one another, using cash. Because cash is easy to conceal and relatively easy to steal, businesses keep their cash in a bank account. The common controls are signature cards, deposit tickets, and checks. A signature card is a card that shows each authorized person's signature for a bank account. A deposit ticket is a bank form that is completed by the customer and shows the amount of each deposit. So by customer, we mean the bank's customer who has the checking account. So your company that you're doing the books for, right? You're the accountant working at a company. Your company is that bank's customer. So you fill out a deposit slip. A check is a document that instructs a bank to pay a designated person or business a specified amount of money. The maker of the check is the party who issues the check. So when you're working for your company doing the accounting and you're the one who does the checks, you're the maker. The payee is the individual or business to whom the check is paid. So this part here that says pay to the order of, that's the payee, is the person who's named there. Each check has 2 parts, the routing number and the account number. I'm not sure that's this important to you, but here's the routing number, the first part of the check. That tells anybody who can read this what bank it's drawn on. In this case, this one's drawn on Security Service. The routing number is the 9-digit number that identifies the bank on which the payment is drawn. The account number on a check is the number that identifies the account on which the payment is drawn. So this is my account number right here. So that means it's my account. My bank, routing number, me, my account number. So you'll notice my check is a regular personal check. It doesn't have this little top part. But most corporations and companies order what we'd call commercial checks. And they come with this little strip that lets you keep track of what that particular check was for. Now me, I just have to write my checks, each one down in a separate check register all in a row. And some companies do that too. They don't usually call it a check register. They'll usually call it their cash receipts and cash disbursements journals, right? So it's just writing down your checks. But in this example, you see the check has a little space at the top. So here's an example check. When a check is prepared, it will have a remittance advice, right? That's this. Sometimes called a check voucher, that shows the pertinent information about the check. So here's the check, so here's your payee, here's the maker, Smart Touch, right? Here's the bank, the routing number, the account number, here's the amount they wrote it for. And this is where they're keeping track of, what was going on, what check what was it, right? And how much was it for? And it'll keep the account number too. So my checks don't have this part. Yours probably don't either if you even have checks. But companies usually do have some checks like that. They usually come with some kind of a stub or something. But sometimes they just write them in a separate special cash receipts and disbursements journal. Bank statement. So again, you probably, if you have a checking account, you probably do get a bank statement, but it may be electronic. It might come to you by email or something, and you don't really look at it because you've been keeping up with your checking account online, right? But most companies, right, do get that bank statement, and they do examine it and make sure nobody's done anything fishy. They're keeping up with it. So when that bank statement comes, it's important. A bank statement is a document from the bank that reports the activity in the customer's account. It shows the bank account's beginning and ending balances and lists the month's cash transaction conducted through the bank account. Often, the bank balance on a given date is different from the balance on the books. There are often very good explanations for the difference, such as checks that the company has written and deducted from its books, but that have not cleared the bank. So this is an important concept. As you write checks, they don't come out of the bank right away. Some do, but sometimes you put it in the mail and it gets sent off somewhere and they have to go deposit it, and it takes a couple days before that money comes out of the bank account. So companies, every time they write a check, they're writing down that check and they're calculating their new balance. So they'll have a running balance. So they could actually look at the bank online or get that bank statement and look at the balance. And you know what? It's going to be different from their balance that they've been keeping on their books, right? Because that check is still in the mail, right? Or that deposit didn't quite get there yet. So there's going to be a difference between what the bank has as a balance on that bank statement and what the company that's writing the checks has on their books as the balance. So, to explain the difference between the two unequal balances, a bank reconciliation is prepared. Some activities have been conducted by the business, but there is a time delay between the transaction and when the bank learns the information. These activities include deposits in transit. Deposits in transit means the company has made a deposit, but the bank doesn't quite have it on the books yet. And outstanding checks. So outstanding checks are those checks like you put in the mail and it just hasn't been cashed yet. That's an outstanding check. There are also activities that happen at the bank that the business does not learn about until the business receives the periodic bank statement. These activities include amounts collected by the bank, right? Remember that lockbox? Could be that some stuff came in. Electronic funds transfers, bank service charges, a lot, especially commercial accounts, right? So if you're the accountant at a company and you have one of these company bank accounts with the special check stubs and all that, they charge some pretty high fees sometimes for those special accounts depending on what kind of activity goes on. So you might have a big bank fee that you don't really know about until you see it on the bank statement. All right. There might be interest earned by the company or that is owed by the company, right? So company might have a loan at the bank and they owe interest, or they have some kind of account that pays interest and it got put in their account, so they need to know about that. And non-sufficient funds checks. So if you're the accountant for a company and you're keeping track of the cash and you take and accept a check from one of your customers, you deposit in the bank, but that check was no good, that's called a non-sufficient funds check. So the bank will take it out. They'll say, hey, this check was no good. We're taking the money out of your account. But you might not know that until you get the bank statement. A canceled check is a physical or scanned copy of the maker's cash. So once this check gets cashed, the bank is going to hold on to it and scan it and I'll get to see a copy of it and see what was going on with it. And some banks even return these to the customer after they're done. Electronic fund transfers, ETF, is a system that transfers electronic communication rather than by paper documents. So this is kind of what you probably think of a lot of times. ETF is, it's just going around by the internet, send this money here, send this money there. And that happens a lot between companies too. It's not weird at all. It happens a lot. So this is a bank statement. You might never have seen one. They do send them out electronically usually, although you can still get them in the mail. Sometimes banks charge to send them out in the mail, so you may not get those. So Exhibit 7-6 on page 389 shows the April 30, 2017 bank statement for TuTh. So I just want to point out on the bank statement here. So the bank statement's going to come, and this is what you, as the bookkeeper, let's say you're the person who keeps track of cash at this company, at TuTh Learning. Well, you've been all month long writing down every check you wrote and recording every deposit that you made, right? So you have a balance on your books, and you say, well, I know that's the balance because I'm really good. I never, ever forget to write something down. Well, you get the bank statement, and you see, well, wait a minute, maybe one of my deposits, they list the deposits, they list the checks, and this balance may not be the same balance you have on your books. And when you get to looking at it, you go, oh, well, I see they don't have that deposit I made yesterday. Oh, I guess that makes sense. This was probably already mailed before yesterday. I see that a couple of the checks I wrote haven't cleared, but one of those, I had to mail all the way to California, and one, well, I don't know what's that guy's problem. He just hasn't cashed it, I guess. But, you see some of the checks are missing. So that's why it's important to get this statement and compare it to what you've been keeping track of all month long. And we have an actual name for that, and it's called doing the reconciliation. So let's talk about that. The bank reconciliation is a document that explains the reasons for the differences between a depositor's cash records and the depositor's cash balance in its bank account. Timing differences are the differences that arise between the balance on the bank statement and the balance on the company's books because of a time lag in recording transactions. So what's going to happen, and what we're going to learn in this class, and what we're going to do for homework and on the exam, there'll definitely be a reconciliation, is you're going to reconcile, right? Bring together the balance, which means you're going to say, okay, well, what deposits are missing? What checks are missing? Did a check bounce? Did it get taken out? Did I get some interest? Did a fee get charged? What happened? And we'll reconcile that and come up with the right number, okay? So the next few slides are going to talk about the steps for doing a bank reconciliation, and we'll work through one of these in class one day. So don't worry about that. We'll work it out, and you'll get to do one. I think it makes a lot more sense when you actually work one. All right. You're going to do two sides, right? So when you're reconciling it, when you think about it, there's the bank side, right, which comes from the bank on that bank statement. And there's the book side, which you as the accountant have been keeping. So there's your books, right? The book side, which is the company's records that you've been keeping all month long. I wrote a check, I made a deposit, I wrote a check, right? The book side. And the bank side, comes on the statement. What does the bank say we have? Now we'll reconcile the bank side and the book side. So first of all, there's two sides. So you'd first do the bank side. The bank side of the reconciliation includes deposits in transit, outstanding checks, and adjustments for bank errors. So the bank side of the bank reconciliation starts with the book balance, and we'll write this down in class. You'll see it. So you're going to write the book balance, what you have, and then you look at the statement. What is on here? So if you find Any amounts the bank added to the account, like let's say you earned some interest, or a customer dropped by and paid a check at the lockbox and it got in there and you didn't know that it happened. Any money that came in that you didn't know about, you add that to the book balance. So you write on it's the bank side, you write book balance, cash balance. So, is there anything I should be adding, right? Any amounts that are subtracted by the bank should be subtracted from the book balance. So, if you had a book balance and say the bank took some interest out, or the bank took some a fee, they charged you, the monthly fee, $20. Well, you don't have that on your book, so you have to take that out, right? You're trying to make your book match the bank, right? Okay. Any errors in the books must be included. All right. So then you're going to do the book side, right? The book side contains items not yet recorded by the company on its books, but have been recorded by the bank. A credit memo increases the bank account, while a debit memo decreases the bank account. Non-sufficient funds are checks for which the maker's bank account has insufficient money to pay the check. So, now we're talking to the book side. So you start with the bank balance and you add and subtract these items, and you complete it. So there's an example in the book, and we're going to work through one in class, so don't worry. It's kind of a hard thing to explain, but I think once you see it done, you'll understand. It basically, you're getting the bank statement from the bank, you're taking your book balance on the books, and you're just, anything that either side didn't know about, you add or subtract, and you're going to come up with the equal number. So if you look in your book, you're going to see this exhibit, 7-7 on page 392, lists the reconciling items, and panel B shows a completed reconciliation. All right, so if you're doing a reconciliation, so this is what you might want to memorize. This is what you might want to memorize right here is, if you're on the bank side, you add any deposits in transit, or take out any outstanding checks. And on the book side, you're going to take care of any EFTs or service charges, bank errors. So you need to fix that and make it work. So here's an actual bank reconciliation where you're starting with the bank balance, add deposit in transit, subtract outstanding checks, and come up with a new balance. Over here, you start with the balance and you add and subtract anything that happened, and you come up with the same balance, and that's the actual amount of cash you have. So we'll work one of these. Then, because your book balance is not exactly right? Maybe you had that service charge, or maybe a check got bounced. You have to go back and journalize. So you have to analyze, journalize, and post to the cash account and any expense accounts or things like that. You have to go back, analyze, journalize, and post to make your books correct, right? So what you want, this is what the bank says you have, this is what the books say you have. After you reconcile it, you want this number to be the number that your books have, because that's actually how much cash you really have. So you'll have to journalize those transactions to fix up your cash account. All right? So finally, a journal entry is prepared for all the adjusting items on Part B of the reconciliation. Anything added to the reconciliation will be credited to the non-cash account. Anything subtracted from the reconciliation will be debited to the non-cash account. There are no journal entries from the bank side because we have already recorded those items in the cash account. All right, so at the end, you're going to adjust cash, right? If you've got cash came in that we didn't know about, we need to fix cash. If there was a service charge, we need to fix that. bank expense, utilities expense, anything that happened that we didn't know about, we need to adjust it to our cash. All right, so again, we'll practice some of that, but I think it should make sense. You're just trying to get your cash to be the right amount. Okay, finally, cash is really important, and investors are going to look at your cash and they're going to calculate ratios based on how much cash you have. So you need to understand and as a company too, you need to understand if you're going to be able to meet your obligation, but investors want to know, can you meet your obligations? And they look towards cash to do that. The cash ratio is a measure of a company's ability to pay current liabilities from cash and cash equivalents. So we take this cash ratio is equal to cash plus cash equivalents divided by total current liabilities. A cash equivalent is a highly liquid investment that can be converted into cash in 3 months or less. So a cash equivalent might be something like, so you know, cash is like your checking account and your currency. A cash equivalent might be something like a CD, a certificate of deposit, or a treasury bond, some marketable security that's super easy to sell on a market. So it would not be like accounts receivable, it would not be your inventory, it would not be your supplies. But if you had some really liquid investment that was other than cash, you would add that. So cash plus any very liquid investment divided by total current liabilities. So how do we use it to evaluate performance? Well, you calculate it and you see how much are they going to be able to cover, right? I mean, we always talk, whenever we're in class talking, and say, well, what do you pay your accounts payable with? You pay them with cash, right? Well, if you don't have enough cash to pay that accounts payable, that's going to be an issue. So what would you look at? Well, using the formula, Green Mountain Coffee Roasters reports result of 0.44 and 0.11 during 2013 and 2012 respectfully. Cash ratio above 1 means you have too much cash. However, very low doesn't send a strong message to investors and creditors that you can repay your short-term debt. So see, it's a problem if you have current liability. If you're going to have to come up with $519,000 and all you've got is $58,000, that's a problem, right? This is more like it. In theory, you'd be able to pay those off. Remember, this is like right now I have how much cash. The current liabilities are due within a year, so you might not have to pay all of them right now. 44 would be pretty good. 1 would be, I guess, best, but you don't want a lot more than 1 because you just don't. Cash that's just sitting around isn't making any money for anybody. So it's important to make sure that debts are going to be covered. All right, so that takes care of Chapter 7. So for Chapter 7, the most important thing you're really going to want to know for when you are doing your studying for your exam is you want to make sure you can do one of those bank reconciliations, and you want to be able to do those important journal entries after the bank reconciliation gets done. So we'll practice those in class, practice them for homework. It'll be fine. All right, take care.